Hi, I'm Gareth Kiernan, Chief Forecaster at Infometrics. Welcome to Forecast in 5, where I'll just take you through the highlights from our latest forecast that we've just published. And look, there's not a lot of highlights at the moment, given international events. How are they going to impact on the New Zealand economy? The news, there's not a lot of great stuff out there at the moment. Now, of course, it's a very uncertain environment. This is probably the most difficult and challenging forecast round we've had since the early days of COVID and lockdowns and that type of thing. So we've had to make some assumptions about where we think fuel prices will go over the next few months. And that shows through on this first graph that you see here. Looking at the oil price at the moment, recently it's been sort of sitting in the US $95 to $110 a barrel range, a bit of variation depending on whether there's a ceasefire or apparent ceasefire, good news or not, coming out of the Middle East or the US. So markets have been somewhat variable, but it has been holding it around that range. We've assumed for the June quarter, the international oil prices hold at an average of about 105 US dollars a barrel, so it's a bit higher than they are today. But you can see that is a quarterly average, so there could be some variation around that on any given point in time. Then through the course of the rest of this year, we do expect the conflict. Firstly, we've assumed something lasting in the order of 4 to 6 months. And then beyond that, a bit of a long tail, really, of elevated energy prices due to what's been termed an air bubble in the supply chain, where, we've had this disruption, no ships going through the Strait of Hormuz. And so there will be a period, even if the conflict was resolved tomorrow, where those oil prices remain higher for some time and until those supply chains normalise and that air bubble is worked through. Even over the medium term, we have assumed that oil prices remain a bit higher than they were previously as well. We've seen some damage to oil and gas production facilities in the Middle East, which will take some time to repair. And even out over the medium term, if you looked at oil prices and futures prior to the conflict, they were picking futures pricing sort of $60 to $65 a barrel over the longer term. We think that oil prices will remain higher going forward from here as markets maintain a higher level of risk priced into those international oil prices. Now, what does that mean for us here in New Zealand? We expect petrol prices by the end of this year to have stabilised at around $3 a litre, so not going back to that sort of $2.50 range that we had prior to the conflict. And indeed, in terms of the diesel price, we've seen, of course, the refining margins and the crack spread, meaning that those diesel prices have been even more elevated. We think by the end of this year, hopefully back down to around $2.90 a litre. And then as we head forward out to 2028, then as those margins start to move back to normal, back down to around about $2.30, $2.40 a litre. So similar to petrol, not going back to the sort of levels that we had prior to the conflict. So what does that mean in terms of inflation? This is probably one of the keys at the moment. We see inflation spiking up in the June quarter to potentially 4.8% per annum. That's higher than others are forecasting. But we are conscious, even heading into this fuel crisis, of the sort of inflationary pressures that were bubbling away underneath the sort of headline figures that we were seeing. Remember, we had headline inflation up at 3.1%. So there's still, worse to come in terms of that inflation number. Look, the Reserve Bank can't do anything about that immediately. The question is, where does inflation go over the medium term? And we think that by the end of this year, inflation will still be highly elevated, up at around about 3.9% at the end of this year, even as those petrol prices do start to come down. And by 2027, 2028, up still at 3% as well at the end of next year. And so there is work there for the Reserve Bank to do. We think the higher transport costs will be passed on into costs of other goods and services because firms' margins have been squeezed pretty significantly over the last few years. We've got elevated inflation expectations. And when we talk to businesses, everyone remembers that COVID experience when we had inflation and cost pressures coming through. Everybody put up their price and everybody got away with it. We think there'll be a bit more of that coming through in the next few quarters as well. So the Reserve Bank needs to respond. You can see here the change in our forecast for the official cash rate. We think the Reserve Bank will start to raise the official cash rate from July this year and lifting it 3 times so it gets to 3% by the end of 2026, and then 4% further increases in the first half of 2027, potentially getting as high as 4.5% there. We're even conscious at this stage of potentially a rate rise at the next review in May. Just as I said, some of those near-term inflationary pressures, the Reserve Bank can't stop the higher fuel prices and the higher transport costs, but there's some other stuff bubbling away underneath the headline numbers there that make us pretty nervous as well. Now, from a consumer perspective, consumer confidence is already fragile heading into the fuel price shock that we've seen. ANZ's March survey showed that the responses towards the end of the month, a sharp drop-off in consumer confidence as the reality of those higher fuel costs and the flow-on effects of the war have set in. So we have revised down our expectations of spending growth this year by a whole 2 percentage points, down from 2.8 to 0.8%. People have less money to spend after they've filled up the car. Interest rates rising will suck more money out of household budgets. The labour market is going to take longer to turn around, and people's confidence, they'll just feel less like spending anyway because of everything that's going on, so that weaker confidence flowing through. So very big hit there we see coming through in terms of consumer spending as well. Final graph I've got for you, just looking at what that means for economic growth. Households are not the only part that's hit. We know that businesses will be more cautious around their hiring and investment decisions as well. And so that sort of stuff flows through into GDP. We're cautious around infrastructure spending, especially given the potential for disruptions as those fuel supplies tighten over coming months. We have assumed that we do move into phase 2, potentially even into phase 3 of the government's fuel alert levels as well. And we've seen, of course, cost increases during COVID. We think we'll see more cost increases around infrastructure that will stretch budgets around those construction projects as well. On the export side, we think meat and dairy prices will remain strong, but there are concerns about global growth given what is unfolding internationally and whether that will be hit and negatively affect those export prices. And also international tourism with higher airfares, people less likely to be going on long-haul travel as well. We think that sort of recovery that we've been seeing there for the last 2 to 3 years will potentially come under a bit of pressure as well. Finally, just noting there is a bit of catch-up in terms of economic growth over the medium term once we sort of work our way through the effects of the shock, but the economy does not fully recover the lost activity, the lost production as a result of this fuel supply shock. One thing you haven't seen in terms of the graphs is net migration. We have got a more positive net migration story coming through because net migration is holding up better than we had expected. Stronger population growth, though, means that if you've got GDP growth roughly the same, the per capita performance is weaker as well. So not a lot of good news out there. We think that the effects of what we're seeing in the economy at the moment, they do not unwind overnight. And in fact, some of those will linger for some time to come. So tough conditions for businesses, tough conditions for households. This is a bit like 2025 and 2024, where the message was, it'll all be better next year. We're kind of telling you that again. Hopefully, fingers crossed, the war doesn't stretch on forever. Who knows what the hell is going on with the US and the sort of strategies there, though. And it's a lot of uncertainty at the moment. So, we'll be keeping our eyes on a lot of these indicators going forward and hoping that there's some better news coming through in future.